US dollar index on watch. Okay, so in this video what I'm going to do is I'm going to take you through this blog post here, which I just posted today. I'm going to put the link in the details section of the video as well, so if you want to have a look at it you can do so. So start off here, the US dollar index or DXY is on the move. But what's next and why should you care? So what I'm going to do is take you through each of the three charts and why they matter, and then give you some thoughts on the outlook. So the first one here, after a false breakdown, the US dollar is surging. So we'll blow the chart up a bit bigger. So what we've got here in this chart, in the black line is the US dollar index, and in the red line there, that's G10 breadth. So that's taking basically the 50-day moving average breadth indicator that you often see for the stock market and applying it to, in this case, the currency markets. So it's what proportion of those currencies is the US dollar in itself trading higher than its 50-day moving average, against those currencies. So just to round out the explanation there, as you can see there, when the US dollar had a crack to the downside there, you can see that it became basically it went to zero. So that was what we call there definitely an oversold signal. And actually that brings us back to this little set of blue lines here. We've got a very gentle, gradual, but distinctly upward sloping trend channel here. And for much of basically the last 2 years, that trend channel has held. And we've had a couple of breaks, or a couple of attempts to either the upside or the downside. A lot of false starts here, a lot of confusion being delivered to both bulls and bears. And certainly I would say that the bears would have been being a bit hopeful, or certainly intrigued when they saw it had a crack to the downside of that downtrend channel. In hindsight, that's turned out to be a false breakdown, and it's often the case after a false breakout or a false breakdown, the resultant or subsequent move tends to be quite swift, and that's basically what we've seen here, and it's now tracking up close towards the top end of that uptrend channel, and that's going to really be a key test in my view. And so at the same time we come back to that red indicator there, that red line, and that's actually moving up towards overbought levels now. So when you've got such a enduring trend channel and you've had this move up towards the top end, it is going to be a key test there for the US dollar. And actually at this point I'll go back to the blog and I'm just going to quickly read you out the what to watch for. So as I kind of alluded to there, the main thing to watch for is the integrity of that gentle, gradual but upsloping trend channel. DXY is fast approaching the upper end, and given how robust that trend channel has been so far, we shouldn't naturally expect it to break on first contact either to the upside. So that is, we're about to face the opposite situation of a month ago, where the DXY was attempting to break down and became significantly oversold. So I would be watching out for the DXY to encounter major resistance at the upper end of that trend channel as the market becomes overbought. But if it breaks out of that trend channel to the upside, then we'll need to think a bit about the chart below, the next chart. And the title here is "And Yet, US Dollar Implied Volatility Remains Near a Record Low." So we'll blow that chart up as well. The dark black, or the blacky grey line there, is obviously the DXY, US dollar index again. The blue line is the implied volatility index for the US dollar. So this is an index that I've made myself. It's basically an average of implied volatility from the FX market across the pairs against the US dollar. Think of it like the VIX or the SIBO volatility index for the S&P 500, and but it does work slightly differently in terms of the kind of market signals that you want to get from it. To me, the most interesting thing for this is, well, first of all, let's just look at what the chart is. You can see there that the volatility index is basically at, or very close to, a record low. Now we've had actually a few instances of this kind of behavior in the past. What I'm referring to is when the US dollar implied volatility index goes very low and, basically turns back up. So let's quickly review them here. We've got one there just in before 97 where you had this big crunch in volatility just prior to an actual breakout on price there, and quite a swift and sharp move to the upside. You've got another one there, I think it's 2002, where you had a similar kind of crunch in volatility. When it turned up, you had this big sharp move to the downside. And then also later in the game, so 2007, you had another particularly notable crunch in volatility there. And then when it turned up, you had basically a breakdown there. You can kind of see a breakdown, but also an acceleration of that move, which ended up being quite significant and sharp. And then again, just 2014, I think it was, or 15, you had that again drive to a new record low. And then when it turned up, you had that big, again, breakout this time, and again a particularly sharp and rapid move. So in case you haven't realized the theme there, or basically what I'm saying is that when you get a crunch in volatility for the currency markets, it tends to resolve in violent fashion, or going back to that sort of old market adage, low volatility is a good predictor of future higher volatility and vice versa. So really what I'm saying here is that there is probably an elevated chance that we do see a sharp and significant move in the US dollar. The problem with this sort of rule of thumb, or this indicator, this kind of pattern, is that it is agnostic of direction, but rather it's telling us what to expect in terms of magnitude. And so going back to that previous chart, if we did get a breakout to the top side, that could be, the signal that it's after the races. At that point, volatility turns up and you get a big, sharp, rapid extension to the upside. Or, if it goes back to this chart again, if it bounces off the top end of that trend channel and from overbought conditions, rolls down and breaks down through the bottom, this time as a true breakout, then that could end up being the start of a significant down move. So it's quite an interesting chart really. In terms of what to watch for, I'll just read this one out again. I might be repeating myself, but let's see. That's why I imply the thing to watch for is that if the US dollar index breaks out to the upside of that so far gentle and gradual uptrend channel, things could get interesting. And that is if you find massive and disruptive market moves interesting, which surely some of us do. But equally, and this is where it gets nuanced or complicated, if the DXY hits the upper trend line and rolls over, it could just as well set it up for a big move to the downside. And that's the only issue with the volatility signal. It helps form an opinion on magnitude, but is agnostic of direction. So moving into the last chart, this one I've called Keeping Longer Term Perspective. And we'll just blow that chart up again. And so again, we're looking at the US dollar index, this time over a longer time frame, and we've got some squiggly lines and dotted lines and bold lines in the mix as well. I won't actually go into detail on those, but I'll just, we can look at this chart and really just basically kind of squint our eyes, and you can see there that there's clearly a big cycle in play. Okay, so look at the peak there, and hard to see exactly. It looks like 85. We'll call it 85. The peak there in 85, and then again another peak in 2000, and then fast forwarding another peak in looks like might be 2015 or 16. So the point is, we've got essentially what looks like a 15-year cycle from peak to peak, if you measure the cycle from peak to peak. Now granted, we might see a new peak if that breaks out to the upside, but if we do think that there is this 15-year cycle at play here, then we've basically finished the previous 15-year cycle, and therefore you would call that a tired looking bull market at this stage and be kind of biased to the bearish side, which I am. But then it's also quite a useful chart because yes, we can talk about long-term cycles and ranges, but we can also talk about analogs. So for example, there's plenty of examples where it had sort of last gasp moves. For example, one possible analog for the current situation is the late 90s. You had an initial break through that black line and then it came back down before only to charge back up and even a whole lot more. And then even to the downside there, if you flip the chart in a mirror image, it had that initial breakdown through that black line, came back, retested it, and then had another go even further. So that would give some sort of fodder or encouragement for the bull case there. But anyway, just quickly on the what to watch for. The main thing to watch for with a chart like this is to keep perspective on the contrasting and sometimes conflicting short-term versus medium-term dynamics that play out in this or any other market for that matter. So at this point we're going to go into the final thoughts and bottom line. And I'm going to read this out to you. Bottom line, the DXY is on the move, but it still faces a couple of key tests that should give the bulls at least passing pause for thought. Whether it passes or fails the test, the second or third charts provide some important historical context for what might come next. And so, it's always important to keep track of the outlook for the US dollar. It would be perhaps a bit of an oversimplification to say that it's the only thing that matters for asset classes like commodities and emerging markets, but it certainly is a major factor. If the US dollar breaks out of that uptrend channel and we see a turn up implied volatility, it could set the stage for a sharp and disruptive move that is going to have, be rippling negatively across global markets. And so though I'm medium-term bullish for both emerging markets and commodities, I'm wary that from a tactical standpoint, the US dollar is certainly a swing factor. And so short-term risk management is front of mind, for me as I update my mental models and my Excel models. So look, I'll leave it there. If you've got any questions or comments, any counterpoints, definitely be interested to hear them, so put them in the comment section of the video.